Welcome to the deep dive. Today, we're jumping straight into JPMorgan Chase's Q3 2025 numbers.
Yeah, big quarter.
Huge. And our goal here is simple. Cut through the noise of these record results and figure out what their, pretty cautious look ahead tells you about the economy.
Right. It's a fascinating mix, isn't it? You've got this powerhouse performance, just incredible revenue generation, but then layered right on top, this really careful tone about what's coming next. That's the real story, I think.
Okay, let's get into it then. Starting at the top, the main figures were seriously impressive.
Absolutely.
Net income hit $14.4 billion. That's up 12% from last year.
Solid growth.
And the EPS, earnings per share, $5.07. Managed revenue, $47.1 billion. I mean, just massive numbers.
And the key one for efficiency, that return on tangible common equity, the ROTCE, came in at 20%, which is, very strong. Their own target is usually around 17%.
So they're really outperforming even their own expectations on how efficiently they're using capital.
Exactly. It's a big deal.
That definitely signals strength. But Jamie Dimon always talks about the fortress balance sheet. What actually backs that up? What are the metrics?
Well, it really starts with capital. Their CET1 ratio, the standardized common equity tier 1, is sitting at 14.8%.
Okay, 14.8. And why is that number so important?
Because for a bank this size, the minimum requirement is, maybe 10.5%, maybe a bit higher depending on specifics.
Right.
So being almost 4.5 points above that, that's a huge buffer. It shows they can absorb some pretty major shocks if they needed to.
Got it. But the fortress isn't just assets, it's liabilities too, right?
Yeah.
Deposits climbed to $2.5 trillion.
Yeah, up 6%. And average loans hit $1.4 trillion, up 7%.
So $2.5 trillion in deposits. Is that purely a sign of stability? Or could it also mean, people in businesses are just parking cash because they're nervous about investing? It's a massive liability in a high-rate world.
That's a really sharp point. It is a massive liability, but it's also relatively cheap funding for them right now compared to other sources.
Yep.
And the fact that loans are also up 7% suggests they're putting that money to work, still growing the core lending side, even while they're, focusing on returning capital.
And speaking of returning capital.
Yeah.
Wow. They sent a lot back to shareholders.
They really did. $4.1 billion in dividends.
Just dividend.
And then another $8 billion buying back their own stock, net repurchases.
So $12 billion total in one quarter. That's a very loud statement.
It is. It basically says, 1, we have way more capital than regulators require, and 2, management thinks the stock is a good buy and they're confident about future earnings.
Okay, let's switch gears to the part of the bank that really blew the doors off this quarter. The CIB, the Commercial and Investment Bank.
Yeah, the Wall Street arm. It was exceptional.
Net income for CIB overall was $6.9 billion, up 21%.
Strong. But the real highlight was markets revenue, so all the trading activity.
Right.
Nearly $8.9 billion. That's a record for the third quarter, and it was up 25% year over year.
25% growth on a number that big.
Yeah.
It's just kind of hard to wrap your head around.
It really is. It's almost unheard of at that scale.
But is that $8.9 billion easy money? Or does it take massive risk, huge tech spending, big bonuses? How sustainable is that kind of trading performance?
Oh, it definitely requires all of that, which loops back to why that 20% ROTCE figure is important. They're managing those costs and risks efficiently right now.
Okay.
And what's interesting is where it came from, if you break it down.
Yeah, where do they make the money?
A lot in fixed income. That was $5.6 billion, up 21%. And it wasn't just one thing. It was rates, credit, securitized products. Basically, when things are volatile, clients need to trade and hedge, and JPM facilitates that.
Excess volatility is their friend there.
Exactly. And then you had equities.
How did that do?
Also stellar, $3.3 billion in revenue, up a huge 33%.
33%. Wow.
Yeah, driven by activity across the board, but especially in prime services, servicing hedge funds and big institutional clients. Tells you those players were active, financing trades, taking on risk.
And it wasn't just trading, right? Investment banking fees looked better too.
They did, up 16% year over year, which is a pretty good sign for, the broader corporate mood.
And what drove that?
A pickup in ECM equity capital markets, so companies issuing stock, and also more M&A activity, deals getting done.
So the CIB picture is, it's booming. Volatility, deal-making, it's all working for them.
Absolutely. Robust global activity, at least on the corporate and institutional side.
Okay, but those markets, especially rates and credit, they're linked to the everyday consumer, right? So let's look at that side. The Consumer and Community Banking Unit, CCB, How are things looking there?
Well, on the surface, still looking pretty strong. CCB net income was $5.0 billion. That's up 24% year over year.
24% growth in consumer banking sounds great.
It does. And you see consumers are still out there spending. Mobile customers up 7%. Card sales volume, debit, and credit combined up 9%.
So people are still swiping their cards.
Seems like it. The average American is, still engaged, still employed, using those cards.
But wait a second, you said 24% income growth, which sounds amazing, but didn't you also mention earlier they built up reserves quite a bit and rising credit risk?
Hey.
Is that income growth sort of masking a potential problem underneath? Like they're making more now, but bracing for more pain later.
That's exactly the tension in this report. And yeah, basically, yes, they are anticipating some deterioration even while the current revenues look good. This is where the caution comes in.
Okay, so let's look at those credit costs. What do they show?
The total provision for credit losses money set aside for potential bad loans was $3.4 billion for the quarter. And critically, within that, there was a net reserve build of $810 million.
So they added $810 million more to their cushion than what they actually lost in the quarter.
Correct. They're actively choosing to increase their reserves. About $600 million of that build was for consumer loans, the rest in wholesale. It's padding for expected future losses.
So they expect more people might struggle to pay. Are we actually seeing defaults pick up yet?
We are starting to see it. The net charge-offs, NCOs, the loans they actually write off as uncollectible were $2.6 billion.
Yep.
And that was mostly driven by card services, credit cards.
What was the specific rate for cards?
The card services net charge-off rate was 3.15% for the quarter.
3.15%. What does it tell you?
It tells us that even with jobs being plentiful, the pressure from, sticky inflation and maybe savings running low, it's starting to bite. People are finding it harder to keep up with card payments. It's a key sign of maybe consumer fatigue setting in.
Okay, this brings us to the really interesting part, the outlook. What are they telling us about the rest of 2025 and beyond? Because the performance was great, but the leadership tone sounds...
Very careful. Jamie Dimon explicitly talked about it. He said, sure, the U.S. economy looks resilient now, but there's a lot of uncertainty.
Like what specifically?
He mentioned complex geopolitics, trade issues, tariffs, high asset prices, and sticky inflation potentially staying around.
So the big macro risks.
Exactly. And he said these things mean the bank needs to be ready for a wide range of scenarios. That's code for anything from a soft landing to something worse. It's classic JPM caution, baked into how they operate.
And you see that caution in their actual financial forecasts for the full year 2025 too, right? Especially on costs.
You do. If you look at their projections, net interest income, or NII, basically earnings from loans minus payments on deposits, excluding the volatile markets part, is expected around $92.2 billion.
Okay.
Total NII, including markets, may be around $95.8 billion.
But hang on, their adjusted expense forecast is also around $95.9 billion?
Yeah, that's the number.
So expenses are projected to basically eat up almost all of their net interest income. What does that imply? It sounds like they need those huge trading and banking fees just to turn a decent profit.
Well, it says the cost of running a bank this massive and complex is just incredibly high. You've got huge tech investments, compliance, cybersecurity, integrating past deals, not to mention compensation.
Right.
So yes, they absolutely rely on generating massive fee income from CIB, from cards, from wealth management to drive profitability above just covering those core operational and interest expenses. It highlights the pressure on margins.
And finally, back to that crucial consumer risk metric, the card NCO rate. What's the forecast for the full year?
That's key. They project the card services NCO rate will be around 3.3% for the full year 2025.
Okay, 3.3%. So higher than the 3.15% we just saw in Q3.
Exactly. Just slightly higher, but importantly, higher.
So that's the takeaway, isn't it? They expect loan losses, specifically on credit cards, to tick up a bit more from here.
That seems to be the message.
So, putting it all together, record results now, driven by a hot CIB, but at the same time, they're building reserves, warning about macro risks, and forecasting slightly higher consumer defaults ahead.
That's the picture. Explosive performance meeting cautious preparation. They're capitalizing on the current environment, especially in markets, while positioning defensively for the consumer side and those broader risks, Dimon mentioned geopolitics, inflation.
Which leaves us, and you listening, with a final question to think about. Is JPMorgan just being typically conservative here, using their massive profits to look prudent? Or Are these record earnings actually letting them get ahead of a consumer slowdown they see coming more clearly than others? Something to consider.
Definitely food for thought.
Thanks for joining us for this deep dive into JPM's Q3. We'll catch you next time.